please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, we'll have the early rates coming in from the European markets. In fact, those markets, they have opened up with sharp cuts. In fact, they've opened significantly lower. Investors, they're worried about the US as well as China. They're getting closer to a trade war. So that's not good news. Those markets are reacting to that piece of news, and they've joined basically the sell-off that we've been seeing in the Asian markets as well, which are trending lower as we speak. But let's go across. We are joined currently by Bruno Verstraete, the partner at Lakefield Partners, who joins us to give us his sense about what's going on in the globe. Hi, Bruno. Thanks so much for joining in. Well, how are you reading the current situation? Do you believe that, in fact, there will be some kind of a deal that can be struck, or do you believe that we're all set for this to escalate into a big trade war?
Yes, good morning. I believe that clearly this is a political issue in the first place with clear economic repercussions. I think once that is clear to President Trump and to politics in general, I think they will refrain from further action. Clearly, if the U.S. would have imposed tariffs on all the import that they have from China, and they are a net importer, then inflation needs to be watched. The inflationary pressure on a 20% tariff of a net import of around $350 billion a year would be between 0.4 to 0.6% upward inflationary pressure, which is clearly not the objective of tariffs in the first place. So I think that is clearly something that will and hopefully should take the politicians back to reality, knowing that we live in a globalized world and that they would not only punish the companies abroad, but their own international multinationals as well. And I think once that trickles in, they might actually come to a more diplomatic conclusion.
Hi, Bruno. Afternoon. But, markets are getting punished irrespective. There was a Citi note which said that GEM funds have seen outflows of $2.2 billion last week, which was the largest outflow since 2017. So outflows continue. Your thoughts on the fund flow situation and how it will pan out in the light of all these developments in trade?
Well, I think one of the issues that the markets do not realize yet is that there will be beneficiaries to that as well. All the countries which are not on the tariff list could be the beneficiaries of this tariff war between the U.S. and China. And I think Brazil, for example, if suddenly corn is imposed, then they will be a beneficiary of the tariffs because everyone will source their goods somewhere else. So I think the flows will need to readjust. That's what's making the markets very nervous at this point. Clearly, the dollar and the foreign exchange markets are not helping that. But I believe that this reflowing of trade flows will take some time, but will eventually have some countries that benefit from it as well, including emerging markets.
All right, Bruno, let's talk about the emerging markets then. You were talking about the Brazilian index. Now, that's corrected by nearly around 80% from the recent peak. You have the Shanghai market. That's trading at a two-year low. That's corrected a good 20% from the recent peak. India, well, we're around 4.5% away from the R top. How do you view the India market, the emerging markets? And in that, where does India get placed?
Well, I think the emerging markets clearly have one big clear advantage, and that has been the case for many, many years, which is their growth is outpacing all of the other markets. So eventually, their evaluation and their PEs is going to be at a level which makes it extremely attractive compared to all the other markets. And I think that is what the investors globally are looking into. And that is clearly the case with India. The second thing that is looked at and filtered out is which strengths do they have? Are there specific sectors being more defensive or more cyclical? And that clearly is something where India is clearly standing out, having more focus on, for example, technological companies, which is clearly the sector which is the most loved sector globally, and that will offset some of the weaknesses from the dollar, from the quantitative tightening. And I think that's what one needs to look at, compared to, for example, Brazil, which is more commodity-driven.
Okay, so Brazil could be a beneficiary of that. In fact, as we speak, the selling pressure is intensified. The Dow futures is now down close to about 430 points. Hang Seng is down 950 points. Even in the European markets where they've just opened up for trade, Germany is showing you a cut of close to about 1.8%. And closer home in the Indian markets, at the Nifty, which is earlier down close to about 65 points, is now down nearly about 75 points. So the selling pressure is getting accelerated and the gashes are getting deeper across the board. So Bruno, what is the market pricing in currently, as we speak with this kind of cuts? Is it pricing in that the trade war tensions will escalate from here on?
I think it is, but first and foremost, I think it is fearing that this trade tensions will cause the economy to tip over, and all the beneficial inputs that the politics gave earlier, that these will be offset by a reduction in the profit margins, because if you punish multinationals, profit margins are going to decline, and eventually this could lead to a recession. And I think that's the biggest fear at the market at this stage, and I don't think that is priced in as we speak. Markets have had a very long run. The economy will eventually go into overheating mode. We're not there yet, but the fear of that is clearly on the block.
So if the tit-for-tat trade war continues, the tit-for-tat war of words continues, markets will fall from here on even more.
Well, I think we need to see some sort of sensibility to economic factors, and we haven't seen this so far. This is more of a political war of words without really thinking what it could cause in reality. As soon as the investors see that there is some commonsensical return to reality, then I think markets will calm down quite quickly.
Absolutely. All right. Thanks so much, Bruno, for stopping by and giving us all those details. Looking forward to hearing from you in the near future as well. By the way, keep an eye out on the breadth of the market as well. Now you have only around 450 stocks that are advancing. Close to around 1,500 stocks are declining. So the crisscross lines, they were as away and now they're just drifting apart. Well, on that note, we'll slip into a short break. You come back, we'll continue our focus on the markets as well as on individual stocks.
Welcome back. Pharmaceutical has been the bright spot for the Indian markets over the last few days. Dr. Reddy's 23% rally in the month of June. Sun Pharma 17% rally this month. Lupin has seen a 17% rally as well this month. Today, of course, most of the stocks are flattish too with a negative bias. We spoke to the management of Lupin earlier today. They say the worst of the pricing pressure in the US is now behind. CFO Ramesh Swaminathan said the company will send a final update on the Goa and the Pithampur plants to the US FDA by end of this month. Listen in.
We are also looking at realignment of certain parts of our portfolio, but for sure I think that the worst is behind us. But whilst I say this, generics is going to be, it would be important, but I think our concentration in the future would be on more complex generics as well as on, in fact, the specialty piece that we'll be developing. We've been making our submissions, our updates to, in fact, the authorities. The final update would go at the end of this, by end of this month. Then after that, we need to wait. But we are pretty optimistic that we could see a resolution of this by the end of this fiscal.
Well, and after making some international acquisitions, Dabur is scouting for a buy in the domestic market. Speaking exclusively to CNBC TV18's Priya Sheth, Dabur's vice chairman Amit Burman says that the company is on the lookout for an acquisition in the healthcare space. Let's hear him out.
Demand has directly translated into volume growth for several of the players. Dabur, in fact, clocked in close to 8% volume growth in the last quarter. Do you think we're nearing the phase of perhaps double-digit volume growth? Do you think double-digit volume growths are around the corner? Do you think FY19 is when volume growths will start hitting the double-digit range?
I see that happening, as I said, at least for us, because of distribution expansion, because of election year, and we've also done a lot with doctors. We have now almost 50,000 Ayurvedic centers which are all around the country, which is actually giving a lot of advice and all to the farmers and all what Ayurvedic products to get or buy. So we're doing a lot of stuff behind the scenes to create the demand, to market it. Everything is not to be marketed on TV. There are certain things touch points which you have in the market which is reviving their demand.
You'd say that for a business to get to the next leap, it's important to make acquisitions. It's important to go the inorganic way. So how important do you think are acquisitions for a company like Dabur in India? We've seen international acquisitions playing out.
We really need to get a good acquisition in India. We've been looking around for it. We've got almost a 2,000 crore kitty lying with us, plus of course money we can take from the bank, which we don't have. We have zero debt, so we are ready to do it, but I think we have to get the right product, right brand to do.
Is there an area that you're looking at for this acquisition? Is there a category where you're looking at an acquisition?
I think because our focus has been healthcare, we would look at smaller brands in the healthcare, which have become brands maybe in a small geography, but don't have the money to expand and to bring it into our portfolio. We can distribute it around the whole country much better than anybody else can, because we have that distribution. That would be something which that kind of brand we would be looking at.
Well, if you thought it wasn't a great day for equity markets, take a look at the commodity markets. They are absolutely under pressure in today's trading session. Base metals, rubber, everything's under some pressure. Manisha is with us in the studio to run us through all those details. Hey, Manisha.
Hey, well, absolutely. There's no sector that actually has been untouched with what's happening in sense of the trade retaliation fears there. So as you said, yes, the rubber prices in China, that has led to a decline down by 7%. And that did hit a record lows at one point in time as well. And that really has led to declines in other countries. If you look at the Tokyo rubber prices, those are down by 3.5%. The Shanghai rubber prices, as I said, already have continued to decline. And much sharper declines really are coming in for the metal space, where you have seen the iron ore prices decline by 6%, steel is down 3.5%, coking coal is down 4%. You have the zinc and copper prices, that is the non-ferrous metals, also take a hit because of that. So the zinc is trading 2.5% on the weaker side. Copper is down by 2% as well. The crude oil prices, of course, which started nearly 2% higher in the New York session yesterday, did see a bit of a softness continuing into the day-to-day, and a percentage point down on that one as well. So almost nothing in the global commodity space is trading in the positive at this point in time. Sumit Bagadia now joins us with trading strategies in that space. Sumit, hi, what is your sense? Is it getting weak on the charts as well, especially for the metal space? Because today is a third straight day of decline and a much steeper decline in what we saw in last couple of sessions.
Hi, good afternoon, Manisha. Well, yes, you are absolutely right. What we are seeing is a sell-off in most of the commodities. Now, there is a possibility that we might see extended sell-off in most of the metal stock like copper, zinc, lead, nickel, aluminium. Charts are looking weak. Immediately looking at the charts, what we can sense is that copper is the best commodity to trade in. One can initiate sell positions in copper at the current market price. If there is a bounce back of around 1 to 2 rupees from present levels, then that should be used as a selling opportunity. And on higher side, one can maintain stop loss of around 467 rupees in copper June contract for the downside target of 457 and 455 rupees in next couple of days.
Sumit, with what we are seeing in sense of equities and currencies and commodities as well, do you see any safe haven buying then come in case of the gold and silver prices? Because while we have seen some strength there, is this perhaps a good time to start buying here?
Yes, you are absolutely right. We are seeing selling across the asset class. Looking at the charts of gold and silver, silver is looking a bit bearish, but at the same time, there is a possibility that there can be safe haven demand in gold. Gold is quoting at around 31,050 levels, and from here on, we can see some bounce back or some pullback move, in which we can see levels of around 31,200, 31,250 levels in next couple of days. Downside, it has support at around 3,900 levels. That means till the time 3,900 is not taken away on downside, one can initiate long positions for a pullback move till 31,250 levels. At the same time, silver is looking weak on charts. Seems silver will follow base metals, and from here on, we can see a fall of around 300 to 400 points. So for a trading perspective, one can initiate sell positions in silver, July contract at around 40,000 levels, with a stop loss to be placed at 4,300 on higher side for the downside target of 39,700 and 39,600 levels.
So before we let you go, a quick word on the crude oil prices also, because that has been very volatile. And while, of course, we've seen that 200 rupee move yesterday, today, of course, we have seen a constant pressure in this space.
I think in last couple of days, we have seen a sell-off in the crude prices, and then we have seen a small pullback, and after that, we are again seeing a selling in crude. I think immediately, NYMEX crude is quoting at around 65.20. The range for the NYMEX crude is 67 on higher side, and on downside, $63. I think for next couple of days, it will move in the same range. If anyone wants to initiate a trade at current market price, then that should be on sell side. 44 50, 44, 60 is the current market price of crude current contract. I think one can initiate sell positions in crude July contract because today is the expiry of June contract. So one can initiate sell positions in crude July contract at around 45, 44, 50, 44, 60 levels with a 6 stop loss to be placed at 45.10 on higher side for the downside target of 4400 and 4380 levels.
Okay, Sumit and Manisha, thank you very much for that. Now down nearly 85 points in the Nifty. The Sensex is down close to about 240 points. Commodities is selling off. Vedanta has hit a fresh 52-week low. Hindalco is now down close to about 3.5%. Tata Steel has slipped close to 3% from the top of the day. So incremental weakness coming through in the commodity space. But on the whole, there's clearly a risk-off in the global markets, and that's taken the Indian markets also lower. With that, it's a wrap on halftime report. Stay tuned. Business Lunch will take the market action forward.